Good morning, everybody. Welcome to a free webinar today titled Great Environment for Short-Term Trades, and we'll be talking about a new class that I'll be starting in a week. Welcome, everybody. Let us jump in today. Hopefully, we can learn a few things today. All right, so the next class that we're going to start a week from today is how to make $3K monthly on $25K, and I'll talk about that a little more in a second. Class will start a week from today, Tuesday, November 5th. It'll be a 3-week class, Tuesdays and Thursdays at 1 Central. All classes recorded and archived, so even if you watch it recorded, if you're working, it'll be available a few hours after the class, hopefully, and then you can watch it, ask questions. Live trades each class. Q&A during and after class. You can always ask questions, even months after the class. What you will learn, this and more, right? Why this class is for smaller accounts. So you can put that, so this will be for smaller as well as bigger accounts, but because we're going to focus on short-term strategies, 7 to 17 days, mostly, they will be great for a smaller account. You could trade this with a $2,000 account, $4,000 account, or $5,000 account. And the nice thing is you'll be doing trades each week. So there'll be much more inventory turnover than if you're doing longer-term 45-day trades, which you may be in for 2 or 3 weeks. So this is something you can do with a smaller account, and you get a lot of practice. We're going to cover how to navigate through volatile markets as we'll bring up a price chart here in a little bit. We've had some periods this year that have been volatile. Most of it's been pretty good. We're going to show you how to navigate through this, the different markets up or down with these trades. And many people out there in the option world are used to making every decision based on which way is the market going. I think that's a tough game. For any of you who've tried to pick the market direction, right, every week or month with speculative trades, even though they're exciting, at the end of the year, most people are lucky if they have enough for a cup of coffee at Starbucks. Or I went today to a place called, if you're ever in Chicago, Stan's Donuts. Stan's Donuts, their donuts are like Italian beef sandwiches from Portillo's. Their donuts are, I've never seen donuts like this before. They're power-packed. They're a meal. They're probably 3,000 calories per donut. I've never seen donuts like this. But anyways, so how to navigate through volatile markets, and this is unique. These 7 to 15-day trades as a community, I think our community is probably traded these, been on top of these, perfected these more than any community in the country, just because we focus from the, when weeklies came out years ago, we've been on this and we've enjoyed this, made it part of our options portfolio, and we've embraced it and enjoyed it. And so we've gotten a lot better through learning, making mistakes along the way, how to navigate through volatile markets, and we will share that with you. And this is important, how to navigate the 4 cousins. The 4 cousins are the key 4 strategies that we'll use in these weekly short-term trades, and they'll allow us, and when I call them cousins, and I'll talk a little bit about that today, one set of cousins will be the calendar and the butterfly. Why? They're basically the same graph. One you do when the vols are a little lower, one you do when the vols are higher. So if every Tuesday we're putting on either a calendar or a butterfly, and then the other set of cousins, iron condors and double diagonals, maybe on Thursday, you have these non-directional trades that it doesn't matter what the volatility environment, we could put these on all the time. So really the key with these short-term strategies is the 4 cousins. You can throw a double calendar in there, but you basically are trading the same 2 to 4 strategies all the time. Each week, maybe you're doing 1 or 2 of these. And so we'll focus on these. Why beginners can learn this quickly. why I think this is even for people that don't know a lot about options. One, because you're trading every week, you're going to learn the craft better. And number two, we're not doing a lot of adjustments. So it's really kind of like the Karate Kid. Remember the Karate Kid, and his instructor was teaching him wax on, wax off, wax on, wax off. We're basically putting these on, putting these off. So even if you're, more in the beginner, intermediate stage, there's not we're not getting into heavy gamma, theta. It's a pretty simple system. It can be. And then here's key on these 2 points, simple parameters. So as you navigate, Dan, what do I do when the volatility goes up? What do we do if we have a correction? What do I do if my toe bleeds? What if I do if they don't have a Stan's Donuts in my area? What do I do? How do I know which duration to go? How do I know when to play, when not to play? What if the market starts correcting? What do I do? What if Jim Cramer falls down on stage doing one of his things and says, don't do short-term trades? What do I do? We give you basic parameters. I always use a lot of analogies with driving a car, weather conditions, and surfing, even though I don't know anything about surfing, right? I always look at, we give you parameters when to surf, right? If you're used to surfing 4 or 5 foot waves, right? We give you deep thinking. When the waves are 7 or 8 feet, get out of the stinking water, right? We give you parameters here that you can see. You don't need to be a brain surgeon, right? Simple parameters when to play. We also give you simple parameters when to seek safety. What does that mean? If you're in a 7 to 15-day trade, you're going to be more susceptible to a price move than a 40-day trade. So when the volatilities kick up, when the volatilities go up, which happen when the market goes down, we'll give you clear instruction on when to go out further duration. So because we've been doing this for many years, and a lot of people in our community have been doing this, we're able to give you some instructions to really help you along the way and not make as many mistakes as you're doing it. How to do a system in current low vol environment. October is the first time we've been in this low volatility environment with VIX 13, 14 in 3-4 months, right? We've been, if you look, and we'll look at a second, we've been in a higher volatility environment. So we're going to focus on this current environment. How is this class different than older classes? I've done a short-term strategies class maybe a year ago or somewhere around there. And before that, again, we've gotten a lot better at it from trading this for a year, over the last year with the 4 cousins. I have some tweaks on this. Our parameters for duration, when to play, have changed a bit, and it's just it's quite a bit different. I've learned a lot over that, so there'll be a lot of different things and techniques in this new class. How do we get an edge in this system? Why does it work? Well, it's time decay is a big thing. We're doing positive time decay income trades. The options we're selling more extrinsic value than we're buying. We're getting probabilities in our favor by not staying in these trades till expiration. So we have an edge. We have a pretty easy system to follow. When I say how to make 3K on 20K, 25K, what are my assumptions? The assumptions are you're looking at about $3,000 a month. So that's, if you look at 25K and you look at 3% of, what's 3% of 25K? 750. So we're looking at 3K on 25K would be 750 a week times 4 would be $3,000. Now, is that realistic? Where did I get this $3,000? Did I get it from a Walt Disney movie? No, I got it from, believe it or not, people like myself doing it. Dino, even though he did bad math here, he's a very good trader, and many other students in the community. And if any of you have done income trades, iron condors, butterflies, calendars, you would echo this. If any of you actually have done this over 20, 30 weeks and done it similar to what we're doing, these are not abnormal results by any stretch of the imagination. Pretty normal. Now, again, the other thing that'll hopefully be encouraging to you, each class, we're going to do 6 classes. We're going to meet twice a week for 3 weeks. Each class, I will bring on a student for 10 minutes, talk about their journey, who's doing this, right? And it won't just be experienced students like a Dino or somebody. I will bring on, if there's 6 classes, I will bring on 3 beginners and 3 people who have been doing it more. When I say 3 beginners, 3 people who are, hey, they've been doing it for 15 weeks or so, and talk about how they're doing. So this won't, so it'll be extremely realistic class. We've been doing this a long time, all live trades. That's my 2 cents. I'm excited about this class. I think it'll be a big help to you, very practical, and hope to see you a week from Tuesday. Today, as we look at the market, we're around this 30-45 mark. VIX are very low, and I'll get to ATR in a second, but the range, the thing you need to focus on as a trader is what's the range? Is it important to know, this is a 1-year price chart in SPX, is it important to know what SPX did a year or 2 ago? It is, but you heavily weight what's gone on in SPX over the last 3 months. So if we just kind of look at this period from mid-August or beginning of August, September, October, if we focus on this last 3 months, right, this is the last 3 months in the SPX, the range in the SPX has been roughly 28.25, and for most of it, 28.25 to 30.20, 30.27, we'll call it 30.25. And just in the last couple of days, right, we've broken out of this range to the upside, and now we're at 30.47. The volatility during this 3-month period has been between about 13.5 to the 21-22 area. Today, as we speak, we're about 13.16. Over the last 2 days, as we've popped over, kind of broken out to the upside to all-time highs, or, in the stratosphere here, volatility has gone lower. We've dipped under 13 a little bit in the 12s, but we are that's kind of the environment that we're focusing on. If you look at, this is at the end of, I'll get to your question in a second, George, but this is the beginning of 2019 is here. How many of you remember, as you were opening up your Christmas gifts on Christmas Eve, how many remember at Christmas Eve thinking, we're down 20%? We're having a major correction. Anybody remember that? Today we're at all-time, we're near all-time highs. Does anybody remember almost a year ago, less than a year ago, we were in the midst of a 20% correction, and SPX was in the 2350 level about 700 points ago. Do you remember that? Are any of you older than a year that you remember? Okay, good. Some of you remember that. Scott doesn't remember it. He was in the Brazilian rainforest at the time, and they did not have internet, so he doesn't know that. JJ says, I remember because I didn't close my in-the-money put, and in January I lost it. Okay. All right, so you guys remember it. But during this period, and that's what we're going to show you during class, how do you navigate through this? We got is of October 10th, and I just remember that because that's my wife's birthday, which would be about here. We weren't in on short-term trades during this period. We were doing different things. So you have this rough period where the waves are high if you're a surfer, and then you go through this most of the year, starting at February all the way to like May. Very nice 4-foot waves, good driving conditions. Then the weather condition got a little choppy. Then it was nice, a little choppy here in August. Very nice. So during the year is no different than weather in Chicago. During the year for SPX on a typical year is no different than the weather conditions in Chicago. Most of it's good driving conditions. You get a little pocket in December, January, February, bad driving conditions, then it gets better. And no different than if you're a surfer. Usually it's good surfing, but sometimes the waves are too high or too low. And so what we're doing is just helping you when the weather conditions, when we need to tweak something, right? We're not focusing on where the market's going to be in a week or two, because I don't stinking have any idea where it's going to be, and neither do you, right? Some of you might be decent at it, but, these are things we can control, and they're, so we don't worry about what the market's going to do, right? If the market starts we're at 30.44. How many of you think the market could back off from here, right? That's a deep thought, right? That the market could back off from here. But how many of you think the market's going to back off from here? Yes or no? You got to have an opinion, right? Yes. Okay. Right? Is it a stretch to think that, what are we up for the SPX since Christmas Eve? 30%? Of course, right? But here's the beautiful thing about this type of trading. I don't know where the market's going, even though I have an opinion like all of you. If you ask me, do I have an opinion on the Cubs? Do I have an opinion on the Chicago Bulls since I live here? I've got an opinion on everything. I'm a Chicagoan. But I don't put my opinion in terms of consistently making money. My opinion doesn't mean anything to me, right? But I'm confident in this type of trading that no matter what the market decides to do, right, we'll navigate through this stuff, right? If it gets too choppy, it gets too turbulent, we're going to be out early, right? And we'll be shifting different things. So that's a relief, right? Can you imagine if the success of the system was contingent on Dan or your opinion on where the market's going? No, that's stressful, right? A lot of people, a lot of traders that I talk to, even a lot of traders in Sheridan mentoring, they get so stressed out, right? Oh, the market, it's going to crash, and it's going to go up, and it's going to go down, and Kramer said this, and Freddie said this, and Fibonacci said this. And I mean, oh my goodness, what a way to live, right? I don't care where it goes, right? Right? Well, I'm aware of where it's going. I'm aware of where we're at. But when we see indicators, when we see things getting a little more volatile, we act on it, right? So when we look at ATR here, ATR is simply a measurement of, if you measure most of the last 3 weeks, let me ask you a question. Most of the last month in the SPX has the distance between the high and the low in SPX on a given day been a lot or a little? Most of the last month in the SPX has the distance between the high and the low in SPX in a given day, we call that range, has it been a lot or a little? It's going to be hard to lose money, right? Why? It's not moving enough. So you could see on range-bound type trading, what we're looking at is not which way the market's going. It doesn't matter. We're looking at speed. We're looking at the range, right? Type of thing, right? And you can see here when these candles on price charts get bigger, that means there's more of a range in SPX. So really, that's what we're watching. We're watching the weather. We're watching these things and just making little tweaks. So it's not something to be fearful of. George says it is a challenging environment for premium sellers. No, I don't think so at all. I think most of this year has been wonderful for premium sellers. The last month has been wonderful for premium sellers, right? It's been great. It's just like in any year, it's seeing when you should be making a little bit of defensive measures. When the candles and the ranges and the volatilities make it more difficult for that. But I think it's been a wonderful period, other than some bumps in here. George says, I mean, of late with VIX under teenage status. No, this is wonderful for doing income trading. Let me ask you, what is income trading? George brings up a good point. What is income trading? Does anybody know? How would you describe income trading? If someone said to you, yeah, Dan Sheridan did a webinar on income trading. What is it? What is that? How would you describe that to your neighbor? Dan did. So income trading are trades that benefit from positive theta, right? Time decay, kind of like an insurance company, or selling more extrinsic value than we're buying. Does it matter to us if the volatility is, if the VIX is 12 or 13 or 18? Here's my answer in Spanish, a little bit of French, and Norwegian. No. No. Do I like a little bit of premium? Yeah. Well, let me ask you, with the VIX where it is today at 13, has anybody ever heard of a strategy, right? They've just invented this strategy in the last week. It's called a calendar. Anybody ever hear of that? I'm joking. Anybody hear of a strategy called a calendar? Let me ask you a question. Is a calendar an income trade? Is it a positive theta income generating strategy? Yes or no? Yes or no? This is deep. Yes. Yes. So in a calendar, Dan, how is it a positive income generating strategy? You're selling less extrinsic value than you're buying. But let me ask you, the calendar, you're short, and we have an example of one. Your shorts are going to be decaying a lot quicker than your longs, so it gives you positive theta. So in a low vol environment like this, remember I talked about four cousins, the four key strategies we do. We do butterflies, iron condors, credit spreads. Those are strategies that will benefit when there's more extrinsic value or more time premium in these options. When volatility is higher, that's what volatility does. Volatility measures the extrinsic value of an option. In a lower volatility environment, there's strategies called double calendars, double diagonals. They benefit beautifully when volatility is low, right? Howard says debit to open. Now, again, let me just say this. How many of you have hang-ups with debits and credits? How many of you think that debits are better than credits? How many of you think that it's better to do a trade for a credit than a debit? That has nothing to do with it, right? Whether you do it a debit or a credit, it doesn't. Now, if you're used to going to a bank, right, and you think, well, Dan, at a bank, it's better to have debits or credits better than a debit. We're not in the banking business. We're in the options trading business, right? Calendars you do for a debit. Iron condors and credit spreads you do for a credit. Calendars are a debit. Butterflies, you can do them for a debit or a credit. So with butterflies, if your belly button feels better with a credit, you can do butterflies for a credit, right? If you're okay with the debit, I do butterflies for a debit, right? It doesn't have anything to do with your profit, right? So, all right, well, let's move on here. So I'm just going to give you a couple examples of what I'm talking about, these short-term trades. Again, I heavily encourage you, right? The cost of the class is 3-week class? I believe it's $297. It'll be 3 classes. It'll be well worth it. If you're seriously interested in becoming a craftsman and developing this, you're going to have a wonderful opportunity to see stuff that's been done. We've been doing this in our community for years, and you're going to save yourself a lot of work, but to see how it's done, right? There's nothing kept from you here in these classes. Here's an example. If I put on today a butterfly 17 days out, that'll be 2 weeks from this Friday, right? That's as far as I go on these short-term trades. And these short-term trades are just really the key with these short-term trades is we get a lot of theta on these trades for these short-term trades. So here to be an example of a short-term trade that we'd be putting on a November 15 weekly. That's 2 weeks from this coming Friday, right? And these types of short-term trades, we're putting them on every week. So the turnover's there. You're putting on and taking off a trade every week. So you're putting 4 trades on. If you're doing 45-day trades, let me just say this. Remember that song, what was that? When I was in the 70s, Bachman, Turner. How many of you remember the group Bachman, Turner, Overdrive, right? Ain't seen nothing yet, right? They were there. You know, you can't forget Bachman Turner Overdrive because their songs were like, you know, it's like heavy boom, 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 boom. I remember those songs. But anyways, if you look at, I forget my analogy, but if you look at high energy, that's it. I forget what my point was. I did have a good point, but I forgot. But so here's a 17-day butterfly, and this is all calls. I'm doing it for a debit. But you can see here's the profit at expiration. Here's the P&L. So you can see if we stay around, right, we're doing this at the money. We're selling two options. This is just a call butterfly. We're selling two options at the money, right? We like selling at the money options with calendars and butterflies, right? So the foundation of a butterfly and a calendar, the way we do it for income is sell the at the money, sell the at the money, sell the at the money. Why do we like to sell at the money? Anybody know? Why are we so excited about selling options at the money? Why are we so excited in calendars and butterflies of selling at the monies? Lots of theta, but why? It's the biggest theta. At the money options, you're selling the most, as Rick said, the most extrinsic value, right? So in butterflies and calendars, our edge is not in probabilities, right? No way, Jose. It is the way we trade it, right? You can get probabilities in your favor on these non-probability trades by not staying in them long, which we do. But the key is we're selling, very simple here. Even if you're a beginner, you can get this, right? We're selling more extrinsic value than we're buying. That's it. Say it again. We're selling more extrinsic value than we're buying. Dan, does it get deeper than that? No. Let me say it again, right? Just like in Wizard of Oz, right? There's lions and tigers and bears, right? With that same song, you're selling more extrinsic than you're buying. Oh my, you're selling more extrinsic than you're buying. Oh my, that's it, right? That's the key of it, right? You don't have to understand the word butterfly or calendar or booga baga or haga huga or huga haka, right? You're selling more extrinsic than you're buying. Oh my, right? That's it, right? You're selling more extrinsic than you're buying. And that's why you can see at expiration in 17 days, how in the world we're paying $860 for this trade. How in the world is there the potential on this, an $860 investment, if we close at the money where we're selling more extrinsic than we're buying? How is it possible that a strategy that we paid $860 for can be worth over $2,000? How is that possible? Because we're selling more extrinsic than we're buying. And if it closes at the short strike, not that we bet on that, that's like hitting a bullseye. But that's the principle is because if we close at 30.45, all that we sold is going to zero, and our longs that are buying less extrinsic we won't lose as much with those, right? Right? So how can you make so much money at expiration if we close at the short strike on a butterfly? Here's the answer, which explains how do you make money on this. We're selling more extrinsic than we're buying, and at expiration, if we close at our short strike, everything we sold our shorts for is going to zero. So we're selling more extrinsic. That'll all go to zero, and we'll lose a lot less on these. That's how we make money. Does that make sense, even if you're a beginner? Any beginners, does that make sense? Are there any beginners here where at least what I said, you can grasp the extrinsic value part? I didn't get into gamma or theta or double Fibonacci, right? I didn't make it that difficult, right? That's it. Now, do we manage it? Do we hold it till expiration and hope like Dorothy in The Wizard of Oz? I hope it works out. I hope it closes at the short strike. No, we don't do that, right? The probabilities of it closing at the short strike in 17 days, closing right where it is today are not high. So we don't do that, right? Right? And we will show you how to manage that. But this is a debit transaction. The trade would be $860. So as Rick says, well, you're at the monies, have your most extrinsic value, and here we're buying an in the money and an out of the money. In the money and out of the money options have less extrinsic value than the at the money. So all we're trying to do is squeeze a little bit of lemon out of the lemon, squeeze a little bit of orange out of the orange. We're an insurance company, right? And we're trying to suck a little bit of lemon or orange out of our fruits or whatever they are, and get it out, right? And that's really the gist of this, right? And this is a butterfly. It has, these are your position Greeks, right? That's all. But again, do you have to be a Greek expert to do this? No. We're basically going to teach you a methodology. Put it on, take it off. Put it on, take it off. Now, you learn these things, and they're important. We want to keep our position deltas, right, close to zero. And when you think of deltas, if you're a beginner, just think in terms of stock equivalent. If I'm long 2 deltas, it's equivalent of being long two shares of stock for a short move in the underlying. If I'm short 2 deltas, think in terms of being short 2 shares of stock. That terminology. So we like to keep our beginning position deltas closer to zero. This is a little more short than I want to be, but usually, and we're relying on this positive theta, right? So if our theta is around almost $20 for the first day, and then that number goes up, right? And what does that mean? This theta number, which is key with these short-term trades. What it means is if each of these options, the 3010 strike, I'm buying one November 15 weekly 3010 call. I'm selling 2 November 15 weekly 3045 calls. I'm buying one November 15 weekly 3080 call. What it's saying is if the option volatility of each of these options goes down, or excuse me, I said that wrong, with theta. What it's saying is, as each day passes, right, today I'd be making $17, and if we just take one day, right, we're just advancing one day forward, theoretically, I'd make $17. And then tomorrow to the next day, that number is going to grow. So it's just saying because my shorts will decay quicker than my longs, it's quantifying, giving you a rough theoretical number of what I'll make each day, right? And then we give a simple plan of what to do here. Now, so far, you can see you don't need to be a neuroscientist at options or a PhD in options to understand what I've been talking about. And the next point that I'm going to tell you, the most important thing, right? Becoming a successful option trader, right? The next thing I tell you, there's not one of you that can tell me I don't understand what you're saying, right? It has nothing to do with options. Besides being consistent and doing this every week the right way, but doing it consistently, the other most important thing in becoming a successful option trader is keeping your losers near your winners, not more than your winners, right? You know what that's called in English, Spanish, and Russian? Risk management, right? Everybody can whip these things on, right? I can teach the cooks at Chipotle in an hour to put this stuff on, but I can't teach them in an hour how to manage this stuff, right? And the key is, and it's really based on discipline, right? It's discipline, right? You know, that's why I've always said, don't be mad at me, but I've always said this, and I still believe this, right? This doesn't come down to how smart you are, but I still believe this. If I took a group of 5th graders from Chicago or California or Mexico or whatever, group of 5th graders, because they listen to you, and I said, look, this is what I want you to do. This is how you get out. But when you're at this point, you get out, right? if we had a contest, who can make the most money on these short-term trades over the next 6 months? If I took a group of fifth graders and I took you guys, they'd beat the pants off you. Beat the pants off you. Well, you say, Dan, how is that? How can that happen? We know more about options than they do. It has nothing to do with that. They'll listen and they'll be disciplined, and when it's time to get out, they'll get out. You guys are you're distracted. You'll be distracted. You're looking at 4 different webinars. You got 17 different newsletters. You're doing all this crud. You're not doing anything consistent. They'll kill you with this stuff, right? I don't mean to be mean, but it's a fact, right? Right? You know, and the students who end up doing well at this, are they smarter than everyone else? No, they have 2 things. They like this stuff, right? You know, if you take someone like Dino or people who are doing this, they like this stuff, right? And they're disciplined. They like it and they're disciplined. They like it and they're disciplined. They like it and they're disciplined. That's it. Anyways, I don't want to be dramatic here. Last thing, and I'll let you go. Calendar. Here's a 10-day calendar trade. I did this today, right? We're right at the money. We're at 30.44 in the SPX right now. And I'll also teach you to do this. We'll do some in stocks. I mean, we do a lot in SPX and RUT. You can use SPY, IWM, well-diversified indexes. Again, you can do this stuff all the time, right? Here's a calendar, right? We're around 30.42, 30.43. Right now we're at 30.44 in the SPX. So what am I doing? I'm selling a November 8 at the money, 30.45 call. And in this particular example, my long is going 1 week out. That's a calendar trade. What's a calendar trade? Calendar trade is sell a duration, a near-term duration at the money, by a further out duration at the money. Now, if you want to do it the way we do it for income trading, positive theta trades, we do them at the money. If you're more directional, you'll do a strike further out of the money. So we're selling so this is very similar graph to a butterfly, right? That's why I call them cousins, about the same graph, right? Same graph. It's just calendars you would favor more in a lower volatility environment, and butterflies in a higher. But between the 2 of those, you can trade them every week the rest of your life, right? If you know what you're doing. So here we're selling a November 15, 30.45 call. And here's another debit transaction, right? And we're buying the Nov 8, 30.45. So how do we make good money at expiration on just a $650 investment? Because your short option is going to decay a lot quicker than your long option. Even though in this case you're buying more extrinsic value than you're selling, the November 8 expiration is going to decay a lot quicker than the November 15. So again, we're trying to squeeze a little money out of the orange, squeeze a little money out of the lemon. That's it, right? Right? But I think what keeps a lot of people from being successful is they're not used to following a plan and being disciplined, right? They're used to, right? I think this is going up. I think this is going up. I think this is going up. I think that, you know, it's a tough existence. So anyways, folks, that's kind of my 2 cents. I'm excited to do this starting next Tuesday. I think you'll get a ton out of it. Whether you've done this with me before or if you've never done it, you'll learn a lot. We've tweaked this a lot in the last 6 months, and it's exciting. Any questions before we leave here on some of this stuff? Right? Well, obviously, we'll be in class covering this. Again, here's what I promise you, even for beginners. This will not be neuroscience. We'll give you very simple methodology. You need to be willing to do it and practice, right? TJ says, do you use any technical analysis in selecting your trades? I don't. Not in this type. I mean, technical analysis is I think useful, TJ. But again, if we're doing stuff at the money, theta, we don't. We look at some. You know, I guess, do you consider ATR a technical? Would ATR be considered a technical? Okay, yeah. So yes, we look at technicals. when determining weather conditions, but we generally try. So yes, we look at these, but we look at it differently, right? How many of you would agree it's difficult to pick the direction of the market on a short-term basis every week or two, right? How many of you think you can make a living picking the direction of the market every week or two? Yes or no? Be honest. Are there a few that can do it? Maybe a few. I don't know anybody, right? But I'm sure there's a few who can do it. But what I'm guessing is, but here's my point. A lot of people do this in Sheridan Mentoring. Not a little bit, a lot of people. A lot of people do this type of trading because it's easier to understand, but it works, right? It's there's a reason, right? There's a reason Warren Buffett invests in Geico. Agree? Is there a reason Warren Buffett invests in insurance companies? Is there a reason insurance companies generally are a good business? Yeah, I think so, right? Right? It's this positive theta in decay. And so, yes, but TJ, don't make it clear. In no way am I, yes, are we putting this stuff on a regular weekly basis? Yes. But we are absolutely on the pulse, locked and loaded on what's going on in the market. Agree? We are locked and loaded on indicators, ATRs. If something's going on, and one thing, if a correction's starting to develop here, right? We are on it like pigs in mud, and we are calling TJ's house, TJ, get out, right? Now, what's the difference? What if TJ decides not to listen, right? TJ may say, well, Fibonacci, Gubernacci, Habanero, Bupanaro, Hapa Hapa, so yes, we're on but for this type of trading, what we need to do is, when are the waves too big to surf? When is the weather in Chicago too bad to drive? That's our focus, because that's for this type of trading. Now, in the spec part of our portfolio, right, more directional, we may look at more directional indicators. For the long portfolio, long-term investor, that's different. But this is for this positive theta income-generating trade. So anyways, folks, I look forward to seeing you next Tuesday. You'll want to be there. It'll be a big help to you. If you have any questions, you could email me at dan@sheridanmentoring.com. I'll encourage you to go to our front website, and you should be able to sign up for that. It starts next Tuesday. Have a wonderful day, and we will see you later. Thanks. Bye-bye.